Thank you all for attending the session. And I would like to give the whole idea in terms of what is the whole reason why we look at have a session now from a retirement planning perspective. I think one of the key thing, if you look at even from a government perspective, also now they are looking at how they can able to take the advantage of NRI funds, especially from a UAE perspective, which is a tax-free regime, which can help them to build a good FCNR deposits. So now we have seen that same way for NRIs also, it's very critical to plan their retirement because that's the most critical thing. Because most of us clients, when we have a call with them, one thing which come up that most of them don't have a clear number in terms of what is the retirement corpus they need. And today in this session, we'll try to cover up and looking at from a different angle perspective. Just to give a brief about Right Horizon, so we've been industry 20 year plus managing 2,500 crore assets and servicing 800 plus NRIs families. And our whole focus is on the core advisory, which is something which we'll focus as a part of overall our journey. So, first thing we want to look at that why NRI planning retirement is different compared to a planning for resident individuals because there are multi layer of things which needs to be looked at. One of the biggest thing is currency risk because we have seen that how rupee depreciation impacting significantly the corpus requirement for NRI. So that's one of the key thing which make a difference. Secondly, in terms of the taxation impact, multi-jurisdiction perspective, because being as an NRI, it's always be a challenge post-retirement perspective because kids may be staying in a different part of the world. So it's always becoming very challenging that they may not have a clarity in terms of where they will be end up having their retirement life, and that could be possible at a different stage of a life at a different place. Secondly, in terms of how we consider the cost inflation, because if you look at post-retirement, healthcare is one of the biggest expense what we consider, which needs to be looked at. And India perspective, we have seen that healthcare cost is significantly higher, even considering having a health insurance, because many of the expenses which are not get covered as a part of healthcare. So that is something which needs to be planned separately. And most of the time, people do a mistake that they just look at money what they require as a part of household expense. And the biggest thing which is going to impact the retirement significantly get out of their planning because many times people may end up need even a caretaker at a later stage or somebody need support system. So that's the one thing which make a lot of difference. Secondly, the lifestyle inflation, because most of the times we have a thought process that okay, post retirement we will not have a EMI, we will not have a kids education expense, so technically our expense will be on a lower end. But in today's time frame perspective, considering the type of lifestyle what as an individual wants to live, that make a whole difference in terms of the expense perspective. So that's the reason what we believe that the expense which was there pre-retirement, most of the time they end up being at the same place post-retirement also because your healthcare and travel. So these are the two major component which get added to the overall cost perspective. And third component, if you look at today's perspective, I think the tax part, because many of the investments which was not taxable earlier, like for example the equity part, today it is taxable. So tax also play a very major role in terms of the overall expense perspective. So that is something which we always think we have to consider. And the overall longevity, because if you look at today when we are doing a planning, we don't plan till 85, we plan till 90 because the overall expectancy has increased, which technically means that people needs to plan it for a very long duration of a time. So it's almost like equal to the time which they have spent for earning. Similar period will be when they're not going to earn. So it's a huge difference in terms of the corpus requirement, what it will require. And these are the common mistakes what most of the NRIs make. For example, underestimating corpus. They think, okay, once we have a 3 to 5 crore of a corpus, it's good enough. But what we have seen, keeping current scenario into perspective, typically at 8 to 15 crore. So normally we say 10 crore is the ideal corpus what somebody should plan from a retirement perspective, so that he can have a good lifestyle living, plus able to build emergency corpus, because most of the time people not able to look at the healthcare cost. The second part which very critical is that planning in home country currency only. So today we look at more from a global perspective, because that make a lot of difference. And many of them because are earning NRE FD tax free return, so keeping everything on FD. But tomorrow once they shift to move to India or other part of location, then the things change. So I think we have to look at the post tax yield, post retirement perspective also, because that is going to change the whole things together. And considering that what is required in terms of the overall corpus perspective would change. And one of the major thing we always believe that post retirement perspective, I think the liquidity is the most important thing. And many times we have met a clients who have a 25 30 crore of a corpus, but their 70 to 80% of the corpus is on a real estate which is illiquid and not able to yield the way it required. So, what we suggest over a period of a time that yes, real estate is a good investment option from a longer term perspective, but it needs to be not over allocated, because it will end up impacting your liquidity and the overall returns in a longer period of a perspective. So this is the some of the we just want to share the data that how things change. So if you look at 10 year down the line, the 100 rupees will be become 56. So technically, if somebody have a 1 crore of a portfolio, if you look at is not invested, keeping as a just as a fund, it will technically become 56 lakh. So that is the reason what we always believe that your return should be higher than the inflation, and our focus is that at least to have a 12% aggregate return, so your money can grow double of the inflation, so that it's going to make a difference in terms of the overall corpus requirement perspective. And secondly, if you look at, because life expectancy increase, so that also required people needs to plan for a larger corpus. And the most important thing, the healthcare part, which we already covered, why it is required. So we are just trying to show it on an easier level. So we always believe that retirement planning is always customized and it has to be looked at from an individual perspective. But we have just given the overall number perspective that what is the corpus as an individual perspective it required. So today, if somebody needs to plan for a 3 lakh of a month type of a monthly expense perspective, so at least 10 crore of a corpus, what we believe it should have as a retirement perspective. Same way, if you look at want to have a corpus wherein he wants to live part in India, part in Dubai or US. So in a different scenario, the corpus requirement will change, because that's the most important part which as an individual needs to be looked at, that the corpus is always depend on the type of lifestyle and the country where they're going to stay, and that is where our role come into the picture in terms of plan it well. But if you look at the ballpark number from a today's perspective, what as an individual should plan, that at least to build a 10 crore of a corpus at the time of retirement, so that irrespective of which part of the world they wants to stay post retirement, their overall lifestyle should not get impacted significantly as a whole. And then we have looked at the multiple things why different countries going to make the corpus requirement differently, because if you look at the tax angle, because country like India, where India, or if you look at on the US, where it is on the higher side, then if you look at healthcare and the cost of living perspective and the lifestyle perspective, so those things make a lot of difference in terms of how somebody should plan the overall perspective. Because, like for example, UAE today tax free, so it add a lot of value uh, in terms of getting a good saving. But in India also, up to 12 lakh of income, yes, it's a tax free. But the moment somebody go on the higher income slab, that tax will go on the higher side. Same way, the healthcare is something where people end up paying higher side in India in compared to the other countries. So, and the last important part, the currency impact, because the overall rupee has been depreciating 3 to 4%, which technically impact significantly in terms of the corpus perspective. And this is the overall trend which we have looked at, that how currency has moved. And one thing which we always try to showcase, that, for example, if in 10 years, if USD INR perspective move, today already it's 94, 95. So if you look at, there's a huge change. So if you look at in last 10 years, people have look at from a currency perspective itself, they have lost almost, like on a 10 crore of a corpus, almost 17%. So it make a lot of difference for someone to plan in terms of the investment perspective. So today we are suggesting that the overall allocation needs to be at a multi-currency and a different investment option, not just looking at India as a whole perspective, depending upon how they are planning post-retirement perspective. And today, GIFT City and global funds have become a very attractive option in terms of investment option perspective. And even I think the FCNR FD, which is a recent announcement by the government, wherein RBI will take care the hedging costs. So because of that, today the FCNR deposits are giving almost 6 to 7% return, and with leverage as an individual level, they can see almost 15 to 17% type of IRR return from a 3 to 5 year perspective. So today, FCNR deposit also becoming as a very good option from an investment perspective. But there are certain risk factor which somebody needs to look at. That today, for example, the borrowing rate and the deposit returns, if it should be at least 1.5 to 2% difference should be there. Because in case if there is an increase in that borrowing rate, then the benefits what they are seeing today may not there in future. And secondly, the tax implication, because for example, country like UAE, you may not have impact in terms of the tax angle, but for other places, they have to look at how much they end up paying as a tax on that investment also. And third is the liquidity part, because these are from a 3 to 5 year perspective investment. So in case of a pre-withdrawal, you may end up losing the whole benefits of the investment. So that also is very critical, that that should be based on the time bound fund requirement perspective. But yes, overall perspective, this has come up as a good option for someone who is looking at from a 3 to 5 year perspective investment. Considering this window is for a very short period of a time till 30th September only. Secondly, I think the most important thing, the inflation part. So average normally we look at 6%, but if you look at for a different category of the requirements, especially education, healthcare, and the lifestyle inflation perspective, that's on the higher side. That's one of the reason why the corpus requirement from individual to individual completely differ. So somebody may able to have a good healthy lifestyle living in India, even with 1.5 to 2 lakh of a corpus, but for other person, it may need a 3 lakh of a month, because the healthcare cost and the lifestyle inflation make a lot of difference, considering a lot of expense go towards travel also. How the overall retirement planning asset allocation needs to be looked at. So we always believe that again there is no fixed formula which should be looked at, because there are multiple factor which needs to be looked at as a whole, which includes that what is their existing corpus they have built up, and secondly, what are the other source of income and other thing. But ideally, one thing we always believe that as an approach, what we do is we create a different bucket of portfolios. So the first bucket, we always believe that 3 year of a fund, at least what is required, it should not link with the market, so that irrespective of how things are there, it should not impact your portfolio significantly. Then you can have a second bucket which can have a balanced funds and bonds and other thing which could have a medium risk, and funds which you need after 10-year perspective that can go to high aggressive equity, AIF, international fund and other thing. So the moment you bucket your investments based on your fund requirement, then automatically you don't need to look at the risk factor in terms of a day-to-day market perspective, because today, for example, investments which is done from a short-term perspective in the equity, it can impact significantly, because the person needs to lose the principal itself if we exit at an early stage. So we always believe that you should have a strategic allocation, but we should not have a thought process that post retirement I should not have equity. Equity is a very essential part of an investment, even post retirement perspective. But as an approach, what we do, we believe in a hybrid investment approach, because what we have seen that hybrid and a multi asset approach works better than just going on a pure equity approach. On the larger corpus perspective, so that you can able to have a similar return what you are able to have even in a pure equity perspective. And that is something which I'll cover as the next part of session, where I'll show you how it make a difference. And maybe before that, Tara, can we have a poll?
Yes, sir. 1 minute.
So, just want to get a more sense in terms of what is the biggest retirement planning worry right now, because most of the times the planning going to work better when you are able to take care of your worry part, because that is something which is help, because that's the first thing which we always try to do, that have a personalized investment strategy which take care of your need, and how we are able to give the options accordingly. Because many times we have seen that people end up going very aggressively in equity, thinking that I'll be able to build a larger corpus, and actually they are the one who exit early from the equity the moment they see a market volatility. So we always believe that just to build a corpus, taking a high risk, not going to add much value, because every asset class will go through their market cycle. And we have seen last 1.5 years where equity markets have been flat, at least India perspective. But that is where the global diversification will help, because if you look at global markets have done well in the same period. But today it's a reverse, where we are expecting that India will do better on the overall perspective along with the other emerging markets, because from a valuation perspective, today markets are attractive, at least on the large cap perspective, if you look at. Yeah, so we can end the poll. So I think the biggest retirement worry at this point of time, what most of the people have seen, that not having enough of a corpus and fear of return out money. So I think the solution for that, if you look at from a long term perspective, will be how your overall portfolio is able to yield. So we always believe that. The most important part is if your overall portfolio is able to give 12 to 15% type of a return, then you are on a right track. I think that is what should be your ideal focus on the optimal return perspective. You should not look at more than 15%, because we end up losing then on the portfolio also, because it will increase your overall risk. So our approach will be that how we do look at the combination of investment options and able to add value. So I think If you look at mutual fund, PMS and AIF will become as a first part of the allocation. And today, with Gift City and the global allocation, add a lot of value. And on a combination approach of buying on the stocks and ETF, give a lot of advantage, because if you look at from a global market perspective, ETF work better than buying individual companies from a overall return perspective. And NPS also is coming out as a good option for someone who is looking at post retirement regular income perspective, apart from the pension plans as a regular income source perspective. So I think the combination of approach which works as a whole, considering how it works. But just to give an example, we just shared one example. Most of the time, people think that if I need a high return, I have to go only on the equity. But if you look at hybrid and multi-asset approach, works differently. I've just given a one example, so this is not a fund recommendation. The only reason why I'm sharing this data, so that you can see how it make a difference. So last 15 years, if you look at Nifty has delivered almost like 11% to 11 to 12% what Nifty has delivered. But if you look at the same time, a fund which have almost like a 50% equity allocation, uh, able to deliver better return and with lower downside. So I think that is what we try to do as a part of our investment approach, that trying to build, look at the options where you have a lower risk but able to see the better return. And especially you can look at the periods where markets were down significantly, like for example 2011-12, when Nifty was down minus 8.1, it has delivered 5.8. Then 15 to 16, when Nifty was down, again it was flat. Then 19 to 20, then in a flat market, positive return. Then if you look at last financial year, when Nifty was down, it has given a positive return. So overall perspective, it has worked better as a whole. But when markets have done extraordinarily well, it has underperformed. So that's the one thing which we always try to explain, that all the investment option is not for all the time. There are different time frame where it will work. So when markets are doing extraordinarily well, it will not outperform, but it will protect your downside risk as a whole. So this is the one approach we always believe post retirement perspective is going to help a lot, where your risk is reduced, because these funds will have a very low equity allocation. And this we can see from this chart, that how the allocations are changing. So currently, if you look at, almost 50% around is the net equity allocation, and it is very dynamically managed. So whenever markets going high, equity exposure is going down. So and whenever markets going down, it increases the equity allocation. So which makes sure that we not end up having a very high equity allocation over a period of a time. And secondly, which most of the time people have a question, that when markets are not doing great, how we can have a stable return. So this part also, these dynamic funds are able to take care. So we have seen, like, there are multiple periods when markets have not done well, but as a fund level, they are able to generate almost 8 to 9% type of a return, even a flat market scenario. And later stage, it can be used for SWP also, because if you look at, as it's been a dynamic fund as a overall perspective, so even keeping taxation impact also into the mind, it will able to generate almost 11 to 12% type of a return. And this is a live example of a fund for last 15 years, how it is able to create a good amount of a wealth. And even we can use dividend option also if somebody have a lower income. So depending upon the overall tax structure, this can be looked at as a whole. And from an NRI perspective, if you look at, because of the DTA impact and other things, the tax angle also can be looked at, and we can have a thing where the tax impact also not come as a whole. But I think that's a whole approach. Second, what we believe is that multi-asset approach is going to be a future of investing, where we need to have equity allocation dynamic with a mix of equity in which preferential, gold, silver, and other thing, because that is something which is going to help to build a portfolio very stable. And able to build a good performance. And that is what we have seen, that the multi-asset approach portfolio, if you look at in a longer run, so that is the most important part, which most of the time people end up looking at. They look at from a short-term perspective, but I think our belief is that if you look at from a 5 to 10 year perspective, the multi-asset approach able to give at least 12 to 16% return most of the time. So if you look at almost 75 to 76% of the time, portfolio give more than 12% return, which is very critical from a post-retirement perspective. And you will not have a negative return at a 5 year down the line perspective. So that is something which is very critical from an investing perspective. And these are the country-wise the rules and how things work. So especially like country like UAE, we have seen that because of the tax benefits and everything. But TRC certificate is something which is going to help if somebody wants to save what they end up paying the tax on the, especially on the mutual fund investment perspective. So that is something which can be helpful. Secondly, NRE FDs, especially FCNR one, can be a very good instrument from a current scenario perspective from a UAE. And US, again, there is a different compliance and other risks. So always we believe that there is no one option which is good across all the players. So country to country rules going to make a difference, because like in US, the tax implication have an impact where pool investments are not advisable, considering they end up paying the double tax. Then, if you look at from a different accounts perspective, I think NRE is the ideal way if you look at from a repatriation perspective. And FCNR could be a good way in a current scenario perspective, because RBI is taking care of the hedging cost for the bank. So FCNR deposits are giving almost like a 6 to 7% in dollar terms, and with leverage, people can end up having the higher yield. So that is something which could be a good option from a today's perspective. In NRO account, especially from India perspective income, so somebody having India income, there he can look at NRO as an investment option perspective. So, and the existing investment perspective, like for example, EPF, PPF, and NPS. So, EPF, yes, they can withdraw later stage, but they cannot contribute further. PPF, again, they cannot do it the further deposit, but they can include on the existing. NPS, it's a good instrument if NRIs wants to look at on the government investment option perspective. The only challenge, the pensions is taxable. The next plan comes from an insurance planning perspective. So we believe that having a good life and health cover make a lot of difference, because it will take care in terms of the overall cost perspective. And we can look at healthcare options, which is international side. And the most important part, planning on the state and the legacy protection perspective, because many times that become very critical, that how we are able to plan as a part of the long term perspective as a whole. So I think estate planning perspective, the what are the key things which you look at? One is the nomination. All the investment needs to have the nominee. Then will, and that there also we need to have a separate will, because many times people do a mistake that they create a will, one will which because Indian will not be work on the global side, so they should have a separate will thing. Then POA, especially for property transaction perspective in India, and the trust structure also make a lot of sense for the larger corpus, because that will facilitate and take care in terms of any sort of a risk from a longer term perspective. And the cross border planning also is very critical, because many are the areas which we need to look at how we are able to have things, because DTA doesn't cover the state, so it need a separate planning, because we have seen most of the time people don't have a India specific will 78%, and a lot of people have faced issue because of missing nomination and other things. So how we can plan retirement planning? So one is multiple strategy which we use. One is SWP type of a strategy. Then we build a bond ladder strategy. even on the global bond side and other thing, depending upon the risk profile and the overall requirement. Then dividend income strategy, where we'll do a mix of high stocks, REITs, InvITs combination. And fourth, for someone who don't want to take on the very high risk side, annuity and pension plan works as an alternative way where they know today itself. Like for example, today we are able to have almost 7% type of annuity yield, where you have a complete clarity for a very longer period of a time. That also make a sense for someone who wants a clarity on the cash flow perspective, but don't want to take any sort of a high risk on the investment side. And these are some examples just to look at that how the overall planning make a difference. So someone working in the UAE, for example, having planning a retirement in coming to India. So how the his planning is going to make a difference as a whole. So I think that's a one thing which people need to look at. So if somebody need currently 3 lakh a month, so over a period of 20 years from a retirement, see the fund requirement will almost will become 3x. So 3 lakh will become almost 9 lakh 62,000. So even at a 5% systematic withdrawal rate, which is on the higher side, typically we suggest 3 to 4% as a thing. He needs to build almost 23 crore of a corpus as a whole. So technically, if you look at almost 9,580, what we have to build, and when we are doing the planning, we should not look at more than 12% overall return, even from the equity perspective also, because in a long run, we have seen that returns have come down significantly. And then you need to do the changes in terms of the overall strategy, because accumulation phase, what strategy, what we are using to a consolidation and the distribution will be completely different. So that is the most important thing where you need a lot of regular review and changes, and have the overall planning on a state perspective and the healthcare perspective, which is very critical. Similarly, if somebody from a US, the whole things will change completely compared to UAE, because the a lot of reporting, PFIC rule, FBAR, dual taxation, social security, and those things will come into the picture, which is not there in case of UAE. Same way, for example, if somebody is returning to the India at the retirement, then the whole things will change, considering from which country is coming, what is the pension income and other thing he's having from there. So somebody is coming from UK, his planning is completely different compared to US and UAE, considering their pension and the tax implication and other thing. So that's a one thing which we try to look at, that how we have to plan, because assets movement from other country to other, how it is going to impact on the taxation side, and how we will able to make sure that even the next generation should not get impacted significantly, because that's a one thing many times people don't realize, that we have to look at from a future perspective also, that any investment which we do, that should be very easily accessible, even for the kids also, so that tomorrow they not end up having a lot of hassles, because many times we have seen that they don't even look at those investments, they leave it instead of coming and handling those part, especially on the real estate side. People have seen a lot of issues and challenges coming. So these are the 10 key aways. If I look at, I think NRI retirement is different. So whenever somebody is talking to their friends in India, they are planning at somebody being NRI, it's different. I think secondly, we should have the number, because that make a lot of difference, because it will be changed person to person. So for example, as average number, we say 10 crore, what somebody should have as a corpus, but it will not be exact for everybody. So that is where it make a lot of difference, considering their goals, liabilities, and the aspiration. And currency, I think that's the most important part which we should look at before looking at any investments. And healthcare is something which we should look at, have a thing. And asset allocation is the most important part, because most of the time people just end up looking at how I can increase the return, instead of looking at thinking that every asset work in a different market differently. And the best example you can see today itself, like gold and silver. So last year, gold and silver did very well. But if you look at today, in dollar terms, silver is already down 40%, gold is down almost 25%. So we have seen that there is no asset class which will do well across all the time frame. So we have to have a proper asset allocation to able to plan well. And I think most of the time people are aware of most of the investment options and everything, but delay on their execution that make a lot of difference, because even a 10-year of a delay, it make almost like a 2.8x monthly higher investment requirement that make a lot of difference. And I think we have to look at multiple options in terms of how we do a succession planning, because that become very critical on a longer term perspective. And have an emergency fund wherein it can take care from India perspective and global perspective. So we always believe creating a two different buffer for India expense perspective and global perspective and the travel perspective, so that we not end up needs to move funds unnecessarily. What will be the safe withdrawal rate? So typically, if you look at if it's India only retirement, 3.5%, what we have seen as an average. But if you look at as a best approach will be 3% as an average. What we can look at again depend on country to country perspective. But I think 3.2 as a hybrid, and where somebody have very high risk on the healthcare cost perspective, then it may end up becoming 2.8 perspective. So that is where we have to see that what is the 4% for US may not be for India, and for someone who have a health issues and other thing, it would be completely different as a whole. And I think Gift City is coming up as a very good option from an NRI's perspective. With it will save on the tax perspective, dividend tax, then transaction in the US dollar terms. There is no government STT, GST, and other impact. So, and today a lot of options are coming up on the Gift City side. The major challenge is the investment amount perspective, because most of the investments need almost 2.5 lakh USD dollar. But I think things are changing. So we are looking at other options using global investment routes, where you may not need higher allocation of the fund requirement. And I think returning to India is a very critical part. So somebody needs to plan much advance. So we normally build like a 3 year of a plan as a transition blueprint, that how somebody should plan when they are coming back to India, because you have a RNOR status, which is after 2 years you have. So that window can help to save a lot of money on the tax part, especially on the global income perspective. So it need a lot of planning, and we believe that it's an ideal way is that plan it 3 years before when you are planning to move. And these are the mistakes what we have seen people end up looking at as a larger level. Poor allocation on the real estate. Then on a US perspective, people ignore the compliance part, which impact a lot. Then the currency hedging risk, and people end up keeping their NPS or PPF and PF account left dormant, so that they end up losing in terms of the overall return perspective. And insurance, many times people don't take insurance covers, especially on a health cover and the life cover perspective, which can impact significantly them. And the last is R&R, because that is something which can help at least to save tax for 2 years post returning to India. So these are the 10 golden rules. What we suggest that start early, because I think that is the most important part. I think planning is more critical part, because that is something which is the thing. I think for NRI, apart from inflation, the currency risk is the real, and how you are able to use the DTA, which is a dual tax advantage, give from a safe thing. Then will is very critical, because it become very essential, especially from an NRI perspective, and should have a health and term cover, because that is something which work as an emergency capital from a family perspective. And I think we should have a separate emergency fund, because that is something which is the first thing before starting investment. And I think asset allocation is the most important part, because till the time you have not done the asset allocation, it's going to impact you significantly. I think that's all from my end, just to give her this how we overall plan journey. So depending upon the different life stage, the planning make a difference as a whole. And this is the overall thing what as a right housing's wealth perspective we do for our clients in terms of the overall planning and the investments and the family office services perspective. And you can have a complimentary health check. This is something which we give, where we give a complete clarity on overall investment perspective, and we try to help on overall side that how you can plan it better. So I think that's all from our side, and you can reach out to us and we can discuss it further accordingly. And Tara, we can have the last poll and then we can have the Q&A. Yeah, so just I think we have done discussed a lot of numbers and other thing. Now we want to see if people can get what would be the corpus requirement. At least that could be a key takeaway, because that will give an idea in terms of how you are planning going to make a difference.